Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Please don't forget to like and subscribe and click the bell so you get a notification of when we're releasing a new video. I'm sitting today again with Michael Porter. Hello, Michael.
Yeah, morning, Robin.
Good to be back in the hot seat again. So, Michael, we've, I think we kind of warned everyone when the euphoria of maybe the ceasefire came along that this was still, the effects of the war still had to come through. And I see that ceasefire is looking a little bit tentative and Trump is starting to warn again. But now we're starting to see some pain at the consumer level, aren't we?
Yeah, Robin, I think the problem with the ceasefire is that there's sort of a stalemate and it's going nowhere. There doesn't seem to be any resolution, so sort of days are dragging into weeks and weeks are dragging into fortnights, and there's no change. There's no progress. There's no negotiation. There's no light at the end of the tunnel, maybe, And we've had last week there were two CPI reports out in America and in Japan. Both were a little bit higher than expected. We've got our own CPI on Wednesday that will be higher than expected. Obviously, the fuel price shock coming through everywhere, and I think the higher inflation coupled with the lack of progress or the lack of sort of not intention, but is just suddenly causing markets to sort of focus on where to from here. So oil prices have ticked up again, over $111 a barrel this morning. Bond markets are weakening fast. I mean, US Treasuries are now 10 years are at 4.6%. That's the highest in sort of 2 years. UK Treasuries, UK gilts are at 5.2%. That's the highest since before the financial crisis, but the UK has got its own set of problems. We probably talked last week about whether Keir Starmer was still going to be in power, and we can make the same comments today about whether he's going to last the week. But yes, I think markets are really starting to just sort of say, well, where are we going to from here? And Trump's ratcheting up the rhetoric and saying Iran's running out of time. So are we going back to a conflict? Or is there going to be some sort of resolution? Again, it really, everything just speaks to the fact that Trump has completely underestimated, Iran and the impacts and the force of the US military. And yeah, unfortunately, Robin, it is feeding through at the pumps. I mean, petrol prices are going up. I think we talked about, last time or a couple of weeks ago, obviously the governments had foregone the tax, but they've said that in June and July they're going to start bringing back that tax. So if prices staying where they are, we're looking at another significant rise in petrol prices in June and July, because the tax is going to start being added back, that we haven't had. And so it's really going to start hurting, and I think Asia is hurting more than most regions because they're very import dependent on oil. But it's spreading quite quickly, and Iran and the US don't seem to be in any hurry to bring this to a conclusion.
And Michael, I mean, I was just reading a report this morning that was saying that most global governments have got no wiggle room to help their consumers. I mean, just because of where their own economics are after the events of probably the last 10 years, pretty much. There's not much space to help the average man in the street out from a government level, is there?
Yeah, even in the US, Robin, government, budget deficits as a percent of GDP are sort of 4, 5, 6%. Government debt, so that's your annual budget deficit. Government debt is sort of sitting at 100, 120, 130%. Budgets, I mean, generally under pressure, and I think over the last 30 or 40 years, the socialist budget has increased a lot in terms of welfare and all the other things that governments spend their money on. And there isn't a lot of wiggle room, and we know exactly where we are in that situation and how difficult it has been to try and right our ship. And it's been, a long, painful process, which is starting to finally come right. But even our gains can be undermined by higher bond yields and higher borrowing costs. I mean, you look at the US and the UK. I mean, the US has got significant amount of debt maturing in the next sort of year, 18 months. They don't need massively high interest rates right now, you know. So yeah, it's an interesting time. I mean, if there was ever pressure to get this war over with, it's rising rapidly, but Iran's got other plans.
No, absolutely. Well, from what I can understand is they don't really know who they're even talking to in Iran. It's so divided in there.
Yeah, well, that's probably part of the problem.
Yeah.
But yeah, it just goes to show the law of unintended consequences, isn't it? Yeah.
Absolutely. Michael, I want to circle back to something that you said just now. You said, you know, the bond market is weakening. Now, obviously, you know, when we talk weakening in markets, we talk prices going down. But in the bond market, it's opposite, isn't it? It's interest rates going up. And often the bond market is the canary in the coal mine. So maybe just for the man in the street, give him a bit of an idea of how the dynamics of the bond market work.
Yeah, basically bond yields is the interest rate. So I mean, bonds are issued at a fixed coupon and then they trade. And so the fixed coupon relative to the current price kind of determines the yield. And yes, as yields rise, interest rates are rising. That means the price of the bond is falling. But yeah, Robin, basically bonds are very sensitive to interest rates and inflation. And yeah, if inflation's going up, generally you would expect then interest rates to go up, and that shifts the whole curve up. So if you think of interest rates from 1 year to 30 years, you have a curve. As the short end goes up, then that pushes the whole curve up. Okay. So, you know, at the start of the year, we were looking for 2 interest rate cuts in the US. Now markets are expecting at least 1 hike. And even a week or 10 days ago, I think the markets were sort of on flat for the US. Now, probably saying, well, there's a hike coming. We've obviously got the new chairman of the Federal Reserve coming in, Kevin Walsh.
Lucky him.
Yeah, good luck to him. And yeah, so markets are just starting to price in the fact that actually inflation is becoming an issue. And I think up until now, markets have almost looked through it because saying, well, you know, how long is the war going to last? But I think everybody's just getting concerned now that there seems to be a real stalemate and nothing's happening. And and oil prices are rising as a result of that, because there's no hope on the horizon almost, if you know, if I can call it like that. So yeah.
And of course, I mean, from a bond market, there's 2 aspects. One, government's borrowing money all the time. So if bond yields are rising, it's costing them more to borrow.
Exactly.
But into the equity markets, all shares are really priced off the safe money, which is considered at the base level the 10-year American Treasury.
The risk-free rate, you know, that's essentially the risk-free rate. And we can argue till we blue in the face whether that's risk-free. Yeah. But yes, I mean, you do use interest rates or bond yields as an input into your equity valuation. So as bond yields rise, it's not only bond investors that are losing money and their bonds are going down, but equities basically come under pressure for exactly the same reason. Yeah. But, you know, Robin, again, I mean, obviously these are market movements, and yes, things at the coalface get tougher, but life does go on. And, you know, if there's any resolution, then things would change just as quickly. So from our point of view, it's more about focusing on good quality, sustainable companies with good cash flows than trying to rush in and out of markets, you know, because as much as this week's been a bad week for markets, who knows what happens tomorrow, on Wednesday, on Friday, you know, and yes, it might get tougher, but we just focus on quality. You know, that's really where you want to be at the moment. Yeah.
And Michael, this gives us great opportunities to buy shares at prices that we couldn't get them and wanted them, and so it is the opportunity for stuff that we like. Michael,
absolutely.
Thanks so much for giving us that insight. Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.